So a lot of people think that the infinite banking concept is too good to be true, and it's probably because there's so many online promoters out there that are literally saying things that are too good to be true. That's why I named my company bankingtruths.com. I'm Hutch, and today we're going to go over the top 9 IBC lies. So we learned a long time ago that we didn't need to embellish or exaggerate or straight out lie, especially when we're dealing with responsible and intelligent people, because there's a vacuum in their life for what this does, not only now, but later as well. Where people get in trouble is when they're looking to replace irresponsible savings or spending patterns with some kind of magic bullet, magic unicorn product that's just instantly amazing and awesome forever after, and there's no downside risk, there's no exposure, and not much responsibility needed on your part. It's just simply not true. So without further ado, let's get into the top 9 IBC lies so you can see what to look out for and see if this strategy is really right for you. The number 1 IBC lie is that you're paying yourself back interest into your banking life insurance policy, and you're not. And that's a good thing. Here's why. Well, with the 401k loan, you actually are borrowing from your 401k and you are paying your account back all the interest. This sounds like a good thing. Here's why it's not. In order to create the liquidity for the 401k loan, you actually have to sell investments. You have to cash them out, possibly at the lowest point, because that's some of the best times to borrow. And you do pay yourself back all the interest, but you're the yield. It's a single use asset, and not so with life insurance. So your entire cash value balance keeps compounding even when you're borrowing against it, because you're borrowing against it. It's like it never leaves the policy because it never leaves the policy. The life insurance company is willing to give you a loan because they're holding your cash value as collateral, which means you can earn compounding twice on your cash value and whatever you borrow against it for. IBC lie number 2. Infinite banking is not about positive arbitrage. Yes, it is. It is about arbitrage. I think the reason why certain online promoters are saying this is because there's not immediate and instant one-dimensional arbitrage with whole life policies right now, the policy of choice. And consumers left to their own devices only do what's immediately right in front of them. But to do infinite banking right, it should include a network of assets, in which case you can get immediate positive arbitrage, and they should be taking a long-term approach to not only just acquiring rate arbitrage between what the loan rate is and the growth rate is, but also tax arbitrage. And if you're a higher earner, this tax arbitrage, this tax immunity of the rate you'll earn is arguably as important, if not more, than rate arbitrage. And so sowing the seeds now, even if you don't get immediate, instant rate arbitrage, will be worthwhile. IBC lie number 3. IUL cannot work with infinite banking, and it's just simply not true. So I've owned multiple index universal life policies for over 10 years now. And what I can tell you is, even though caps and floors have gone down, just like dividends have gone down, and even though you do give up a little more, you take on a little more risk because you give up some guarantees that whole life offers, there are some unique benefits to IUL. Uncapped S&P options with certain companies, which really gives you the opportunity for positive arbitrage, even if you're with one of the capped options, as well as locked loan rates in the 5 to 6% range. So even though I do prefer whole life as the foundational piece, and I had that before I got IUL, I do like these benefits. And I will say too that I did underfund some of the policies. The brightest, shiniest objects that I thought were going to be great turned out not to be. What do you know? Whereas the solid companies kept their promises. The ones that I underfunded are still alive and kicking, contrary to what you hear on the internet. IBC line number 4, IBC loans are debt, and debt is bad. Now, we agree that loads of consumer debt left unchecked is a recipe for financial disaster. However, if you were simultaneously building up a safe and liquid asset that was tracking that liability, and you could extinguish the debt at any moment, are you really in debt at all? And if you could earn compound interest on an increasing balance while simultaneously pay simple interest on a flat or decreasing balance, we believe this is a recipe for financial success. Not to mention, you're earning compounding you wouldn't otherwise be entitled to because you would have spent the money and killed the compounding. Now, I will say I've seen some other online promoters showing some very artistic math on whiteboards and smart boards to prove that there's some magic bullet policy where you get this instantly and forever after. And it's simply not true. But combined with the network of assets, you can actually create this phenomenon in your life that can provide some wonderful long-term benefits. IBC lie number 5. refinancing all of your debt through your IBC policies. And we see two different versions of this. One with people with irresponsible spending habits. They have loads of consumer debt at high rates, and they think that buying this magic bullet policy first will help them better manage that situation. Not true, not a good idea. You're essentially financing the policy using those high rates, and it's not going to be able to keep up. What you should do is refinance using one of those bona fide debt services where they'll cut up a bunch of your credit cards, give you a good rate, and we can actually help you rent coverage, get a convertible term policy where you can flip it to IBC whole life whenever you're ready. Now, for responsible savers, a lot of times they have access to really good rates, like they could buy a car at 2.9, but they think there's some magic to borrowing against their policy at 5, when in fact, it's really all about the optionality and having a network of assets and loan options so they can always choose the best one. IBC line number 6, I don't care about the death benefit. I just want maximum cash value. We hear this all the time. I understand it. If you're doing a good enough job with the cash value, you won't need as much death benefit in the future. But the part you're missing is with any whole life policy designed for infinite banking, the cash value has to equal the death benefit on a guaranteed basis by age 120. I realize most of you won't get there, but you get the lion's share of it in your 80s during life expectancy. Think of it this way, though. If there is this reverse gravity, this magnetism pulling up the cash value towards the death benefit, do you really want less of it or more of it? Probably more of it. The other factor is the part that most people really like, the overfunding or paid up additions. Paid up additions are just miniature versions of the original base policy. So the PUA ratios, or the amount of death benefit to cash value, matters, so you can create this magnetism pulling up the cash value on a guaranteed basis. IBC line number 7, the quantity of base policy to PUAs matters more than the quality of base premium and the PUAs. This is simply not true. This has to do with something called 1090 policies, 10/90. We have a very detailed case study on them. And what we found is that even though some whole life companies will allow you to pay only 10% base policy, which grows on its own, but slower than the 90% PUAs, where somewhere between 90 to 95% of that goes straight to cash value, this sounds great on paper, but we found that the quality of the base and the PUAs, which are really just miniature version of the base policy, aren't growing as much as companies that only allow you to do, say, a 1585 or a 2080. And so it's just like a restaurant. The quantity of ingredients is important, but maybe not as important as the quality of those ingredients. IBC line number 8, you must use a non-direct recognition policy for infinite banking. And here's how you know it's not true. The guy that wrote the original book, the late great Nelson Nash, every single example in his book is a direct recognition policy. So both of these things can't be true, right? Here's another both of these things can't be true. I use this example in my very detailed article where we go into the concept and the details about direct versus non-direct recognition. Too much for the scope of this video, but I talk about this story. Your agent is telling you two things, that both of which cannot be true. One is he found this magic policy where you can just siphon immediate arbitrage from the company and all the policyholders immediately and forever. And by the way, number 2 is you're part owner in this company, and it's one of the greatest and most financially solvent companies in the world. Both of these things can't be true, right? Well, they're not. So non-direct recognition just means there's no effect on your dividend on loan money. Sounds great on paper, except when interest rates go up like they did in the 1980s and the loan rate is higher than the dividend rate, you don't get any subsidy or any kind of bump on your dividend, versus if this was direct recognition, you would. Almost all of my policies are direct recognition, just like Nelson Nash, the ones that he showed. And there's a reason for that. It just so happens in the low interest rate environments, I could get better rates using outside turnkey lines of credits. And now that rates are going up, I can't get those good rates at outside lines of credit. But when they raise my loan rate above the dividend rate, they actually pull my dividend up on loan money. Not so with non-direct recognition. So definitely check out the article before you buy into this myth. IBC line number 9, laddering policies are borrowing against one policy to fund another policy and borrowing against that policy to fund another policy is a good idea for IBC. And it's not. It's actually counterintuitive to IBC. It's really just a version of premium finance, which is a strategy that very high net worth individuals use. This laddering of policies is really just poor man's premium finance or homegrown premium finance. And how they're different is with infinite banking, it's all about, hey, I'm going to pump my money into this policy for better long-term growth and some tax arbitrage. And when I need my money, I'm going to borrow against it for other things. Premium finance is, I'm using my money for other things. I don't have a lot of money for insurance. I know I want it. I know I need it long-term. So I'm going to borrow money instantly, fund the policy, and get this long-term arbitrage off the policy. Now, note that there's really no access with the policy with premium finance. And the same is true if you're borrowing against one policy to fund another, to fund another, to fund another. It's kind of like those Russian dolls, right? Every time you start a new policy, you have to take a step back before you start to take these leaps forward. And that could take a few years with traditional infinite banking. Now, when you're stacking it with all these policies, you're also compounding that ramp up period. The same I've seen out there with IUL. Basically, they'll have you start a really big policy and then just kind of lay in and put in this much and then borrow that and then pay some more. Again, a lot of times I think it's just a ploy to sell more insurance. And you have to be really cognizant about what your access is and really what the maintenance is to maintain all of this homegrown premium finance. I don't recommend it. And I think that if control is your goal, then IBC is the better way to go. You did it. You got through all 9 IBC lines. So what's next? Well, now you want to see some data, and we have it for you, even if you're not ready to talk to a human yet. Just go to bankingtruths.com/best to see the latest iterations of whole life policies optimally designed for infinite banking. And that's going to range from the policy with the best early cash all the way to the policy with the best long-term performance. And you're going to see that there's some trade-offs for each and a lot of companies in between. Now, obviously, there's all kinds of qualitative factors too, flexibility, how and when you're going to use the loans, retirement stuff, other riders like chronic illness riders. If you really want to get the best out of your experience, watch the video to see the lay of the land, but book a meeting on our calendar so that you can have a consultative approach to understanding what your situation's like and figuring out what's best. Maybe you have multiple family members and you can break up the best of both worlds between different policies on different bodies. These are all things we can help with. Again, we don't hard sell, we don't push, we don't pressure. We just lay out the toolkit, help you understand your options, and let you pick what's best for your family. What I can tell you is there's been no better time than right now to do it because you're not getting any younger, probably not getting any healthier. And even if you do have some issues, we also know which companies are more forgiving with certain things than others, and we can help route you to the right place. So book a meeting on our calendar, and we hope to talk to you soon.